Welcome back to Retire Right, and it's that time of the week where we aim to make you a smarter investor. This week, we're going to be teaching you the difference between the price of the stock market versus the actual value of the stock market. And this is really important for you to understand because really one of the major themes that we always aim to teach you on this show is how to make good, logical decisions with your investments over time, rather than maybe uneducated or maybe even worse, emotional decisions with your money over time. And it doesn't get much more emotional as far as your money and retirement moving up and down because of, let's say, a volatile stock market. So that's what we're going to be teaching you today, is how to truly understand what's going on. Now, one of the most popular questions I get is, Brad, is right now a good time to be investing in the stock market? However, even more commonly, what I really hear is, Brad, right now does not seem like a good time to invest in the stock market. And what I've noticed over my career helping people is that it doesn't really matter if the stock market's already run up a lot or if it's reacting badly and it's kind of panic time in the stock market. It always seems to be the case where people don't feel like it's a good time to get into the stock market. Now let's take a look at from the depths of March 2009. Okay, so March 2009 was the very bottom of the stock market crash of what happened in our Great Recession. And if you were to look towards the end of 2017, in our example here, so that's about 8.5 years. So from that depth, the stock market climbed dramatically. In fact, if you look at the S&P 500 and you include dividends that were reinvested, the S&P 500 was up almost 300%. Now, even more so than just that was that in 2013, that was the point in time that the market started to make all-time record highs. So in other words, by the time 2013 hit, it had recovered entirely from its peak before the recession. And basically, if you're just out there, kind of in the real world, all you hear every single day on TV or anywhere else is how the market's making another all-time high and how it's making another all-time high. And what that's causing most people to do, from my experience, is make you believe that the stock market, because it's made an all-time high in price, that it must be unbelievably expensive now, and therefore that it's due to crash, right? It's due to correct, and it's really causing a lot of people to miss out on some very good returns over the long term. So we need to understand the difference between the all-time highs in the price versus is something really expensive or is it in a bubble and therefore are we going to see a big correction? Okay. Now, when you take a look at the stock market, there is, and again, please remember, this is not kind of this mythical stock market, right? What we're actually investing in is companies. We're putting our money into corporations that we believe are profitable. And there are a lot of ways to value companies. That's not really what we're here to teach you today, but just a few key things that you want to know is we're really valuing companies based off their earnings, right? Their profitability, both their earnings now, their current earnings, as well as the projection of what their earnings and their profitability should look like in the future. We take a look at things like dividends they might pay you now and in the future, and again, a host of other things like maybe competitors they have or what sector or industry they're in. So again, a host of other things. But the point being is we're trying to find a good value for a company based off its fundamentals. And then as an investor, what you do is you pay a multiple of a company's earnings to try to understand its really, its fair price. A very common multiple is something called a PE, or a price to earnings ratio. Long story short, what it means is if you had a PE ratio of 20, that you as an investor are willing to pay $20 for every $1 of earnings that company has. So again, kind of the larger the PE ratio, maybe the more expensive you might consider a stock. But at the end of the day, what you're going to do is you're going to take the earnings per share a company has, you're going to times it by a multiple, and that's going to equal a quote-unquote fair stock price. Now, if you look at something like the S&P 500, the major companies, kind of the bigger ones, historically you'd want to pay about 17 times their earnings. That's been considered kind of a fair multiple. So let's give you a couple examples here. Let's say that S&P 500 companies were earning, just as an average between them, $125 per share. What you would then do is take that 125, times it by 17, and you would get a price target of $21.25. So it kind of says the S&P should be trading at $21.25. Let's say the S&P continues to rise and it goes all the way to 2,500. This is what investors go, oh my gosh, look how much it's risen. It's unbelievably expensive. I can't invest now. However, what if during that time frame the S&P earnings went from $125 a share to $150 a share? Well, if you took the $150 a share and multiplied it by 17, you'd get $25.50 as a price target. And that is the whole point of this segment. In this example, believe it or not, the S&P at 2,500 was actually considered cheaper than the S&P when it was at 2125. So again, there's a host of other things here. There's a lot of other ways to value a company, and this certainly is not meant to tell you that right now is a good time to get in the stock market or that it's a bad time. What we're really just trying to teach you is really the difference between how it's actually valued versus just hearing about the price of the market or Dow or S&P reaching a new high, causing you to make bad or illogical or emotional decisions. So there's a host of things you need to consider when choosing your portfolio. You'll take a look at the number on the screen or our website. Give us a call. We'll be happy to help build your personal portfolio as well.